Welcome back to The Financial Edge. I'm your host, Alex, and today we're tackling a topic that often gets overlooked in the relentless pursuit of market perfection: the human factor. We're not talking about indicators or charts. We're talking about the silent weapon that separates the consistent winners from everyone else. Joining me to dissect this is our guest, Dr. Ben Carter. Ben is a behavioral finance expert who works specifically with professional traders. Welcome, Ben.
Thanks for having me, Alex. It's great to be here.
So, Ben, the core question we're starting with is this: why can two traders using the exact same strategy and having the same market access end up with dramatically different results? The common answer is luck, but your work suggests something much deeper.
Exactly. That's the classic question that echoes across trading floors. And the definitive answer is not in the algorithm. It's in the mindset. Specifically, the ability to practice what we call constructive self-criticism. Technical and fundamental analysis, that just gets you to the starting line. The skill that keeps you in the long-term game is mental toughness, rooted in an ability to analyze yourself without filters.
Context: why self-criticism matters today. That's a powerful distinction. In today's market, where information is abundant, we're constantly bombarded with candlestick patterns and economic reports. Why is this mental skill more crucial than ever?
Because it touches on the difference between expertise and experience, the first two E's in the EEAT framework we often talk about. Expertise is the knowledge, knowing the patterns, reading the reports, but experience is the capacity to take every mistake, every loss, and distill it into a valuable, actionable lesson. If you can't look at that loss objectively, you're just accumulating screen time, not expertise. You're repeating errors.
So the market loss activates a genuine pain response in the brain, the concept of loss aversion. If we don't manage that pain, it turns into anger or fear, and that immediately blocks the learning process.
Precisely. We confuse constructive self-criticism, which is an objective evaluation, with emotional self-flagellation. When you take a loss, your brain registers pain similar to a physical wound. If you let that pain drive the analysis, the learning stops, and you start looking for someone or something else to blame: the market, the news, the platform. The goal is to separate that emotion from the logical review of the decision-making process.
Core discussion: the trader's mirror. How do we actually separate emotion from logic in the heat of the moment or right after a trade?
The only way is through a definitive, non-negotiable tool, the trading journal. Think of it as your decision library. A scientist would never run an experiment without recording variables. Trading should be a scientific discipline, but most novice traders just record P&L, the pair, and the time. That's insufficient data.
What should a truly constructive journal capture?
4 critical variables, Alex, beyond the basic entry and exit. Emotional state. How did you feel before, during, and after the trade? Were you anxious, bored, or overconfident? The exact reason. What specific written rule or signal prompted the entry? The deviation. If you broke a rule, which one was it and why? And the key metric. Beyond the profit and loss, did the trade maintain your planned risk-reward R/R ratio?
That's powerful. You're not just looking at the money, you're looking at the execution quality. And you mentioned a key insight: reviewing your journal to identify patterns.
Yes, this is where the gold is. You review your journal not to judge yourself, but to find systemic patterns. For example, if you realize that 70% of your rule-breaking errors occur specifically on Tuesday mornings or immediately after a heavy lunch, you haven't identified a flaw in the market, you've identified an inefficiency in your routine. That's an actionable insight you can correct with discipline, not a new indicator.
Emotional insights: taming the ego. Ben, let's talk about a silent enemy: the ego. The material mentions that when the ego takes control, self-criticism becomes impossible because the ego demands to always be right. What does that look like in a live trade?
It looks like sticking to a losing position because you knew it was going to rebound. It's that refusal to admit an initial prediction was flawed. The ego is the high inflation of your trading account. It constantly erodes your real value. It makes you cling to hope rather than facts.
So, financial humility, reinforced by self-criticism, is the antidote.
Absolutely. Financial humility allows you to accept a hard truth. The market neither knows nor cares about your opinion or your capital. A professional trader isn't someone who never loses, it's someone who knows precisely why they lost and adjusts immediately. Humility builds trustworthiness in your process, not in your predictions.
How do we start developing that inner authority?
You have to quantify the emotional errors. Take that vague feeling, say, impulsive entries due to FOMO, and transform it into a measurable metric, like 5 impulsive entries this month. Once it's quantified, you can manage it. If your ego prevents you from closing a bad trade, you must delegate that discipline to the system itself, like a hard stop loss, which is an economic pain limit that forces execution. Self-criticism teaches you to trust your system more than your gut.
Practical application. Stop, review, and adjust. Let's give our listeners an actionable system. The material references the stop, review, and adjust method. Walk us through that process.
This is the core algorithm of constructive self-criticism. It forces a pause between action and emotional reaction, breaking that cycle of impulsivity. 1. Stop. Immediately after you close a trade, whether it's a win or a loss, you stop. You do not look at another chart. You stand up, maybe walk away for 5 minutes. This step is crucial for breaking the impulsive reward or punishment cycle. 2. Review. Open the journal and objectively answer those 4 key questions we discussed: rule, context, risk, and human factor. Be brutally honest. What percentage of the trade was outside your plan? 3. Adjust. Based on the review, you commit to a specific, measurable change. If the error was execution, you panicked and exited early, the adjustment is a commitment. Next time I see this signal, I will stay in the trade for the predefined minimum time. If the error was in the plan, the stop loss was too tight, the adjustment is technical. I will now set my stop loss 10 pips wider for this specific pattern.
That is brilliant because it converts a subjective feeling of guilt or failure into a repeatable, objective process improvement. It sounds a lot like the scientific method.
It is. You're moving from emotional denial to scientific analysis. And once you have that system, you can start identifying more advanced flaws like confirmation bias, only recalling the times you were right, or the disposition effect, which is the tendency to sell winners too quickly and hold on to losers for too long.
So, a final tip for our listeners on fighting confirmation bias?
Assign every trade a score from 1 to 10, based on your adherence to the plan, not the monetary result. If you gained $500 but skipped your stop loss, that's a 3 out of 10 trade, and that's bad process. Your objective should be consistent 9 out of 10 scores, irrespective of the P&L. That's how you forge true trustworthiness in your process.
Conclusion. Ben, this has been an incredible deep dive. The core lesson here seems to be that the market is the vast ocean, but constructive self-criticism is the compass and rudder that allow you to hold your course through the storm.
That's a perfect metaphor, Alex. The only variable you can truly control in trading is yourself. Stop looking for the secret strategy and start looking for the inefficiencies in your own execution. That is the ultimate competitive edge.
And Dr. Ben Carter, thank you so much for sharing your insights today on The Financial Edge.
My pleasure, Alex.
And thank you all for listening. We'll catch you next time.